Hi everyone, John Boardman here, founder and CEO of Ballast, and I'm thrilled today to be joined by Andy Reynolds, who's our Chief Operating Officer, a partner and financial advocate in our firm. Today we are going to be conducting our year-end review. We've done these events in the past, and I think it's a great opportunity to talk about the year, the markets, the economy, a little bit about the progress we've made with clients as well along the way from a planning standpoint. I do think it's also a wonderful opportunity just to give a state of the union of our firm to our clients and the professionals we work with in the marketplace. It's been a great year. I think it all starts with the composition of the people that we have here, which are first-class, trustworthy individuals. And it just makes our days so pleasurable to be able to come in and spend it with people like this. And most importantly, the clients. I mean, I think we have an awesome composition of clients. I mean, they're great people that we get to, we've really developed great friendships and relationships with these clients over the years, and we look forward to many more years of the same. Markets have obviously been fantastic this year, and we love seeing that. I mean, I think it's great to see client account values at record levels, and it's also great to see, that our clients are benefiting financially from a very cooperative investment environment. I think when I think back on the year, though, some of the planning conversations we've had with clients and maybe some of the strategies we've recommended and implemented that they weren't considering, I think that's been really fulfilling to see how that's played out and been beneficial to clients throughout the year. And that's something obviously that we believe is our core competency is financial planning. We think we're the best at doing that. And I think today's presentation, we wanted to pivot a little bit. I mean, we talk so much about planning strategy, and it's often so specific to the household and the situation we're dealing with. Just a great opportunity to talk about more of the investment strategy. So I'll kind of let you touch on that.
Right. And so as everybody knows, we are finishing up our Athenium book. We spent 3 years writing this in the office, our words and our thoughts. We sit down every Monday morning and write a commentary, and we've been accumulating those into the 12 most important financial topics. And so we realize we spend a lot of time on that. We believe planning is very important, and it should be the beginning and a continual process as you invest the money and manage the money. One thing that we don't always spend as much time on is how we invest the money and our process and our philosophy. It is very much rooted in consistent, methodical, and unemotional processes. And so today we just want to share a little bit more about how we do that and what our approach is. And, mine is not different from John's than anybody else's. Our group, we're a team together, and we all come together to make the right decisions. So we'll start off today talking a little bit about the economy. We'll give some positive facts. We'll give some negative facts. We'll talk about diversification and looking in the rearview mirror why we didn't potentially just want to own all the FANG stocks or own all large cap, and going forward, why we believe that owning multiple different things is good. We'll talk about taking taxes and why taxes are a good thing when we're dealing with investments. We'll talk about owning bonds and why we own bonds, and even though we may not love them as much as other opportunities, why they're important to the portfolio. We'll talk about concentrated stocks, what to do with those, and our philosophy with those. And so any one of those topics we could spend the entire discussion on, but we're going to hit them pretty quickly. So coming up in 2020, we're going to have every quarter, we're going to focus on one of those talks and put together another presentation on that as well that we'll share with you all.
Yeah, and I wanted to speak a little bit to today's format. I mean, in years past, we've done live events, and I think those have always been enjoyed by clients and professionals that have been able to come and listen. We had some comments made from clients that maybe we're unable to make it, bad weather, whatever it might be. But also we have a number of clients out of state now, or clients that have moved out of state that previously lived here. So we think this is a great opportunity for us to put together a really deep presentation, which does get into the weeds a little bit in the investment management process in a good way, and also allow our clients the ability to watch it at their convenience and also go back and rewatch some portion of it if it's slightly technical. So I think this is just a really good, concise way for us to get a lot of information to our clients at the end of the year. Like I said, it's been a fantastic year, but as Andy said, refocusing the conversation on the investment management, I think at this point is very critical. Market environments like this tend to make people a little bit complacent and sort of think that everything is only going to go up, and we all know that that's not the case all the time. So I think today's a great opportunity to discuss that.
Yeah, and so we hope you all enjoy this. If you have any questions on the back end, please call us, email us. If there's anything that sparks your interest, I hope everyone knows we're always just a phone call away. We want to be here to help. Also, this is an insight into how we think about investments. So if there's anybody in your life who you think could benefit from just learning more about investments, please feel free to share this with them. So with that, we're going to turn over to Frank and Cameron, and they're going to start talking about the economy.
Hi everyone, Cameron Hamilton, Director of Financial Planning here.
Frank Yoswick, Director of Estate Planning and Tax.
And we're going to be covering some quick hitters on the economy. So what's the economy look like? As John and Andy said, our presentation today, more focused on portfolio management in our day-to-day process, but we can't ignore what's going on in the broader economy around us. So
That's right.
We've been doing some research trying to find some interesting tidbits. You took the perspective of the consumer, more the micro side. I'm taking the perspective of the business owner, macro environment. So what's the first thing that's most interesting to you right now?
First off, I want to talk about the Consumer Confidence Index. And month to month, the Consumer Confidence Index is actually down a little bit from where it was. We're still at pretty high levels historically, all things considered, as you can see on this chart. And what's driving that is the Consumer's Expectations Index, what they think is going to happen in the next couple months and the next couple quarters. That's gone lower, that's gone down, and it's easy to see why. There's a lot of noise in the news, a lot of things that could potentially shake up this good run that we've been having. But the Consumer's Present Situation Index, what they think about right now, the state of the economy, is still high and increasing.
Mm-hmm.
So it's a little bit of a juxtaposition there. And again, month to month, we're a little lower than we were last month. But interesting thing, the Global Consumer Confidence Index is not shown on this chart, but it's remained steady, and it's remained steady at historically high levels for about a year, which is a great sign for the overall economy in general.
Yes, that makes sense where we are in the market cycle. Consumers are happy spending money, but maybe a little bit uncertain about where things are headed.
Yes.
Over the next year and short midterm. That makes sense. I think that'll become a theme here. So I took the business side and I looked at where we are with earnings and revenue. You know, how did earnings season go really with the stock market? One thing I thought was interesting is about 75% of companies reported earnings and revenue beats. So that's up from a historic average of about 60, which is, you know, kind of funny. You know, why wouldn't it not be 50%? Well, these companies all want to under-promise, over-deliver, but it was about 75 this time. So, you know, broadly a good earnings season. One chart I wanted to take a real interesting look at is this revenue chart. So down the middle is all the S&P 500 companies had 3% growth in their revenue, but these two bars on the side, the 5% performance and revenue growth, those are companies that have more than 50% of their sales from U.S. consumers. The lower end that had a 2.1% decline in revenues over the past year, those are companies that get more than half their sales from overseas. So you can see a really big difference between those two types of companies. I think that gestures towards some of the tariff and trade uncertainty that may be weighing on people doing business overseas. So that's something we're keeping an eye on.
Absolutely.
The other topic that I've been talking about for years for any of our clients who have been seeing me do presentation is the Federal Reserve, interest rates. What are they thinking and how is it weighing on our economic environment? So, you know, over the past years, you know, rates have been low, but the Fed really is working on that dual mandate, maximum unemployment and price stability. And when we talk about price stability, we're talking about inflation at their target of 2%. So it's 1.7, 1.8 right now. And the question the Fed's asking herself is, do we need to be pouring gas on the fire? Or do we need to be hitting the brake? And they're looking at data right now, trying to predict forward what the economy is going to look like in the midterm. So really taking medicine for a condition that hasn't happened yet, right?
Tough job.
So one of the terms that you may have been reading, or our clients may have been reading over the last few weeks, is the Goldilocks environment. So if the market and the economy is doing poorly, too poorly, the Fed may lower rates and be more accommodative. If it's doing too well, then they may pull back, raise rates, and be start tightening. So we're actually kind of in that just right portion. That's why they call it the Goldilocks economy. So nothing happened, and we cut rates this time. So the market was poor enough to cut rates, but that helped the stock market in the short term. So could see a reversal on that. It's something that's going to be interesting to watch. Obviously rates are at a low historic level, and we're going to be watching data and on inflation. Another chart here that's interesting is the global monetary policy. A few years back, everybody was blue. Everybody was being accommodated. But you'll see here, there's areas in Europe, Latin America, that are still being accommodative. Some other places, you'll see Canada there tightening a little bit. So as we get out of sync, that's another challenge for the Fed to navigate an environment where what they do may be counter to what some of our trade partners are doing, and that just makes it more difficult to handle there.
Yeah. Next, I want to talk about the state of consumer credit and just where we stand with that as a country of consumers. We have a lot of debt. That's a big surprise, I'm sure you'll know. As you can see on this chart here, a lot of debt, and it's coming from a lot of different sources. A lot of revolving debt, credit card loans, mortgages is obviously the biggest in the blue chart there. Student loans are getting big, and that's another hot topic that everybody's been talking about lately. But consumer debt month to month has been up, and it's at high levels again, and that could be something to be worrying about. It could also be a positive sign for the economy that people feel like, hey, my job's going well. I'm earning more money than I have in the past X number of years. I can afford to go out and spend things, and I can afford to put this on my credit card and be able to pay it off. But that's the key, is to be able to incur the debts and then pay them off and not let that weigh you down. And then kind of piggybacking into my next point here that I want to talk about, with all this mortgage debt being the biggest one, is home building and housing starts.
Sure.
And housing starts are doing really well. We have actually a decline in housing starts, but I look at this as a positive, because multifamily housing starts are down about 28% month to month, but single family housing starts are up. And as we can see here on this chart, we've got kind of a steady upward trend since the last recession of single family housing starts. And I like this. This shows me that people are less interested potentially in renting an apartment, or at least home builders are thinking people are going to be less interested in renting an apartment and more interested in being able to go out and buy their own house. And back to what you were saying about the rates being so low, this is a great time for someone to pick up a 15 or a 30-year mortgage on a low rate and buy their own home, which is something that maybe not been able to do in past years.
Right.
Great leading sign for the economy, because when somebody buys a new house, of course, then they have to furnish it. They've got to buy all the the paint and go to Lowe's and Home Depot and buy all the stuff to fix up their house and get it looking good. So it's a great leading indicator of the economy that people are housing starts are increasing, housing permits are increasing for single family homes, home builders' confidence are at the highest level in a year and a half. So things are looking great on the housing front as well.
Yeah, and definitely a low inventory problem as some of our clients are experiencing. So that's something to watch alongside the difference. I really like what you talked about, the multifamily versus renting, owning. That's
absolutely
definitely interesting things to
positive
watch.
Positive sign.
Well, you had a big positive there. I have more of a negative. If I could point to one biggest negative in the economy right now, it's manufacturing. I think if you look at the S&P 500 and the companies that are leading the market right now, it's really that information sector, technology, healthcare, but more of the service businesses and less of the industrials and manufacturing. If you look at the PMI chart, is the one I pulled for this. So that's a manufacturing survey. 50 is the baseline on this chart. So that means manufacturing is not growing or shrinking. And as you see, over the past years, it's been in the high and mid 50s. So it means, steady but slow growth in manufacturing. Over the past three surveys, we've been under 50. Last time it was maybe 47.8 there. So, as bad as it's been, this is, some people have said, the term manufacturing recession I think that narrowly got missed by the actual percentage drop. But manufacturing has been soft. So that's something to look at, especially if the information, the service sector can't continue to lead. What does that say for our market as a whole? That's something we're looking at.
Yeah.
But then just when we get into the larger business environment, we want to say, are businesses excited about spending money to grow their businesses, or are they looking for places to cut costs and tighten up? That would not be something we want to see for continued growth. So one thing I like to look at is business investment. That's my last chart here. Let's see if we can pull the video down so we can see the right half of this chart here. But this is this is capital expenditures over the past several years. Above the line means growth, so that's good. We've seen over the past year and a half growth, but what we didn't see is a takeoff from tax reform. So what we were hoping to see is businesses got that cash and they did capital expenditures to make profitable projects for the future. I think what more we saw is a hoarding of some cash because of some uncertainty when we get into the trade stuff. Also, some bonuses and raises, which is, especially those raises is good for the economy. But we didn't see a huge takeoff. So I would just say that's something interesting to see. We definitely are still in the positive territory. So businesses are doing what they think they need to do to keep it going, but no huge fuel on the fire here.
Yeah. Mm-hmm. Now, piggybacking off the business thing, I want to finish on what I think is a huge, strong positive, and that's the unemployment and job starts. Unemployment is at 3.6%. We're still around a 50-year low for that.
Yeah.
Black and Hispanic unemployments are at historic all-time lows. Some interesting statistics too. The number of unemployed with less than a high school degree, without a high school degree, that is at the lowest level since they started tracking the index.
Right.
There's
a lot of jobs out there.
There are a lot of jobs. There's actually more jobs available than there are people unemployed, which is another great, it's a great sign for the economy.
Yeah.
The gap between people without a high school diploma and people with a bachelor's degree or more is the lowest since they started tracking that index as well.
Wow.
So great sign. We've been adding jobs for, I think it's 20 consecutive months or more than that, adding hundreds of thousands of jobs a year, a month, more than that per year.
Sure.
Great stuff. Again, these companies are, like you said, they're investing and hopefully they're putting that into hiring more people. And so far the data is showing that a lot of people are getting into the workforce and getting back into the workforce, and our unemployment numbers being as low as they are is a great sign for the future of the economy to come.
Yeah. So I would say, to summarize, a lot of positives, some negatives that more I would highlight is just being uncertainties that everyone's dealing with. But, that's kind of the market we're managing in right now. Some quick hits on the economy. And so I think that makes a great background to Brian to come up and talk about our portfolio management process.
Hi, I'm Brian Burton, Director of Portfolio Strategy. We just heard some great insight on the current conditions of the economy from Frank and Cameron, and now we're going to transition to talking a little bit more about how we at Ballast approach the portfolio management task during difficult scenarios, confusing conditions. So you're going to get to hear from each one of our advocates. Hopefully you'll walk away with a little bit better understanding of our portfolio management process and how we plan for multiple outcomes in order to invest appropriately. Before we dig into the specific strategies that we'd like to discuss, I think it's important that we take a step back and really understand the number one goal of portfolio management, which is to maximize our investment returns while minimizing the risk. So it sounds very simple, but how do we accomplish this? So first, let's take a look at a list of some of the assets that we can invest our money in. So if you start at the top, we've got some of the more secure, safe investment options with cash to bank accounts, on down through bonds, U.S. international stocks, all the way down to what we consider, the most risky investments, which would be buying Powerball tickets or going to a gambling boat, playing roulette. So real quick, let's take a look at a few of these, the risk profile of a few of these assets. So if we think about the risk return of each one of these assets, we think about return on the vertical axis and standard deviation and volatility on the horizontal axis. Let's chart where some of these assets lie in this risk return profile. So let's start with our most aggressive, which would be lottery tickets. So you can see down here almost certainly a 100% loss on your money with very little volatility, because the outcome is almost entirely one-sided. Then if you think about gambling, in this example, let's talk about going to a roulette table and placing all your chips on either red or black. So slightly less than 50% probability of winning there. You're gonna lie way out here on the risk spectrum, and your return over time is actually going to be slightly negative because the house has a slight advantage. Now let's get to more of the the assets that we would invest our client money in. So let's talk about cash. Cash will buy with very little volatility at all. Small return, but it's safe. Let's go on further. This would be maybe a U.S. Treasury bond. Now let's think about corporate bonds. A little bit more risk on the credit side, but also you would expect a little bit higher yield on those as well. We move on out. This might be a diversified mutual fund. And then on up the spectrum, we're talking here probably about a single stock ownership, so a little bit higher risk that you're concentrated in one holding, but you would expect a higher return from that over time too, just with some volatility. And then maybe on further out the risk spectrum, we're talking about maybe venture capitalism, private equity, or those things. So you can see with each one of these assets, as we go out the risk spectrum, we expect a little bit higher return, right? So why is that important? Well, it all matters about this line right here, which is known as the efficient frontier. All right, this goes back to Harry Markowitz, 1952, won the Nobel Prize for economics with modern portfolio theory. Still applicable today, almost 70 years later. So what we want to be able to select from these different asset classes and build the best portfolio we can that has a maximum return with a minimal level of risk. So that would mean our portfolios falling on the efficient frontier. Okay, so our more aggressive investors would want to fall here on the risk spectrum, and maybe a little bit more moderate portfolio may lie here, and our more conservative investors that are more focused on generating income would lie, hopefully here on the efficient frontier. But anything above this line, up in this area, up in here, is unattainable, right? You can't get a portfolio above this line. This is maximum. So think of this as a boundary. Anything below the line, inefficient, taking too much risk for the amount of return we're expecting. So we want to end up on the efficient frontier, okay? So how do we know if our portfolios are on the efficient frontier and that we're achieving maximum efficiency? Years ago, it was basically through observation, through extrapolating data and forecasting our expected returns, expected volatility and correlation for these different assets. And then we plug it into good old Microsoft Excel, and we would find out if our portfolios were on the efficient frontier. Thank goodness for the technology we have today. We save a lot of time and energy because with the data aggregation and portfolio management systems that we have, we can pull that data very quickly, very accurately to determine and make sure that our portfolios are reaching maximum efficiency. Now let's talk a little bit more about our portfolio management process at Ballast. So it truly is a top-down, process-driven, goals-driven process. Basically starts with the individual client's goals, their risk tolerance, their time horizon for investing. any liquidity needs that they may have, etc. And then we build out the portfolio once we've defined all these areas. So once we've defined all these goals, the first step is to build out the asset allocation. So at top level, what mix of stocks, bonds, and cash are we going to hold for this particular client? Once we've come to that determination, we break it down further to the sub-asset class level, where we're making decisions on market capitalization. So do we want, how much money do we want in mid-cap, small-cap stocks? Do we want domestic versus international, growth versus value? Those important decisions are made at the sub-asset class level. So once that's done, we actually go a step further and we move into tactical allocation decisions. So basically this is trying to define trends that we see in the market and in the economy that hopefully we can get out in front of and take advantage of. So, you're talking about things like, do we want low volatility or high beta in our portfolio? We're talking about, do we want credit risk versus interest rate risk? So these are all tactical moves that we make in the portfolio to try to hopefully produce some alpha there. Once we've made all of these decisions, then it's time to actually choose the individual investments that go into the portfolio. So a ton of groundwork is done on the front end before we actually make decisions on the individual investments. And we do that through a very rigorous due diligence process to ultimately come up with a portfolio that's optimized for our clients. So we believe that to effectively manage portfolios over the long term, that we've got to be intentional with our decision making. We've got to be rational, unemotional, and remain process driven. Okay, so there's always a multitude of reasons why we're told that it's a good time to sell stocks, right? Just take a look at this list here. This was put out by Deutsche Bank just recently. So the 20 risks to markets in 2020. If we got caught up and got emotional in reading this list, we would sell all of our stocks. We'd bury all of our cash in a Folgers can in the backyard, and we would never own stocks or any risk assets for that. And although there's some great points here, and we do need to be aware of these risks in the market at all times, we can't get emotional and make irrational decisions based on things of this nature. Here's another chart. It lists all the different reasons why we should have sold stocks over the last decade. Some major events here, and in the moment they were huge. And everybody's saying sell stocks, market's going to tank. Well, if we had held stocks the entire time, we'd be up 257% over that period. Okay, so it's vital that we stick to our process and remain unemotional through all of this perceived chaos. All right. Well, you just heard a great deal about our portfolio management process. And we mentioned Harry Markowitz and the Efficient Frontier. That leads perfectly into our conversation now with Andy on diversification and the importance of that. So, Andy, thanks for being with us.
Yeah, absolutely.
So it's interesting, Andy. Diversification sometimes gets a bad rap.
Sure.
I looked at a chart recently. The S&P 500 has averaged just about an 8% annualized return over the last 70 years.
Yeah.
So help our audience understand why we don't just want to own the S&P 500 index going forward.
Yeah, I think we've gotten that question a lot lately. And it's definitely, if you look at a short-term history, and short-term being a couple of years, or really even going back to financial crisis even, I think a lot of people are falling into that camp of maybe we do just want to own the U.S. markets, and we do just want to own a handful of the companies. So if I prepared a chart for you of FANG, Facebook, Amazon, Apple, Netflix, and Google. And if you look at how these have done over the past 5 years relative to S&P 500, their benchmark, they've 3x'd and
Yeah.
10x'd the S&P. And so I think we're seeing that people getting caught in that trap potentially, and we really want to be careful of that. So ultimately, diversification, what are we trying to accomplish, right? So we're trying to accomplish a couple things. We're trying to avoid having all of our eggs in one basket. So we talked about Harry Markowitz earlier. He proved it many years ago that we can reduce risk. And so Cam will talk about single stock risk and why we don't want it and how to avoid it. Bonds are going to be part of the portfolio that at some point in your life, usually later in life, you're going to own and you're going to want to own. That section we don't like them either, but they serve a good purpose, and ultimately we want to try to not have to sell low. So we want to add that part of the portfolio as well. But really, other than that, there are a lot of other asset classes: small cap, mid cap, international, whether it's emerging or developed. We really want to try to add pieces to the pie that act differently. And so our small cap, our mid cap, it gives us opportunities to grow with a company or a trend, or as things change in the world. Some of the bigger names are going to be hard to keep up with that. And so new companies are going to arise, and we want to participate with that trend, knowing that for the most part, we're going to have a bigger exposure to the companies that are more stable. But we want to participate in that. I think probably one of the questions we get all the time is, well, why do we own non-U.S. stock?
Yeah.
And, that trend has taken a long time to see the benefit of that. But if we look at our political environment, or we look at the headwinds that our population is seeing, our belief is there will be a time where non-U.S. stock can lead again. So we have a chart looking at outperformance of U.S. stock versus non-U.S. stock.
Yeah.
And I think we'll see times where non-U.S. companies begin to lead again. We're in an environment where technology is so much easier, and we're in a world economy. And I think we have to be poised to be able to take advantage of that, and also, again, not have all of our exposure to one economy when we're in a world economy today.
Exactly. I think that chart on international versus domestic is fascinating.
Yeah.
So, we tend to think that U.S. markets have outperformed forever, right? Because of our recency bias. When in fact, if you look at that chart, there are multi-decade periods, or at least decade periods where international is performing, and relatively recently, right? I mean, less than 10 years ago, international outperformed. So that leads in. That's a hot topic always, as is growth versus value. Yeah. Right. I mean, internally we go back and forth on, do we want to overweight value or growth, and that's a conversation we have all the time. And I just recently saw a chart yesterday where value has actually leapt ahead of growth year to date. So, and that's just points to why we have to own these, what seem to be relatively underperforming asset classes. When in reality, we don't know when that tide is going to turn.
Right, yeah, and you look at the way that we construct the portfolios, and it's not the most sexy approach. It's not flashy, owning the most unique things, but it works.
Yep.
And it's consistent, and it has been, and that's our hope. Is that as well as we can predict what's going to happen in the future, which we don't have a crystal ball, unfortunately. We feel like as best as we can create something based on historical knowledge, we're going to do that, but we also recognize there's unknowns coming. Right. So not betting everything in one area. It's just a core fundamental that we believe.
Yeah. Let's shift gears for a moment. So, our ability to purchase ownership in companies has changed dramatically over the last 30 years. From times when people would call their brokers to buy stock, or mutual funds were all the rage, and now with ETFs, really the proliferation of ETFs, it's changed dramatically. So, and that's the conversation we've had internally quite a bit. But can you kind of provide us with your thoughts on what we need to be thinking about?
Sure.
In that area?
Yeah, so like you said, it used to be you pick up your phone or probably get the phone call. Hey, I got so many shares of XYZ to buy. Do you want to buy them? And yes, and you make that transaction. And then came mutual funds and again transaction. And ETFs arose, really got really popular about 10 years ago, and now we're really seeing their popularity. And that's great. It makes our job, we're so much more efficient, we have so many more capabilities to be accurate in what we own and how we own it, and it gives us the opportunity to own more things, which is fantastic. But I think there also comes a risk with that. I was reading the other day, the FANG stocks and Microsoft now represent 1/8 of the S&P 500. So that's not necessarily an ETF thing, but when you own an S&P 500 ETF, you got to recognize you have a higher concentration in a handful of names, whereas you may think, well, I equally own the S&P 500. I think ETFs bring a great opportunity, but if you don't know what you're buying and really understand what you're buying, I think it could lead to some potential harm. Now there's inverse ETFs and there's extra volatility ETFs and there's all kinds of new ETFs, and I think the SEC just released can't remember the number, 100 or so new strategies that they're going to allow. And so if you're not fully reading and understanding all of the information of what that ETF is doing, you could really get yourself in trouble. And if you're looking at performance and chasing what's done well, and you have an ETF that's 3x the S&P 500, and you look at that and you're like, hey, equity ETF looks great, and then the inverse happens and the market falls, it can be really scary. So, really understanding what you own, as we've always said, is very important. I think with ETFs, there's a benefit in how we trade them, right? So we can trade them intraday. We don't have to wait for the market to close, so we can get more accurate pricing and be more efficient that way. But it also means that everybody else can. And when there's a big market sell-off or market purchase, and when there's a lot of volatility, we've seen it exacerbate that. And so we really got to be careful and not be emotional with how we're investing, and be methodical and whatnot. It's also bringing new concerns. We were just meeting with Vanguard. They came to our office and sat down with us to talk about what Vanguard's up to. And they now are becoming significant owners of some of these companies. And that's concerning. They're at the end of the day, when you own stock, you are an owner of that company, and they are growing the size of their ownership. So I found this interesting chart that shows cash flows of money from Vanguard, BlackRock, and iShares versus the rest of the U.S. fund industry. And if we look at this and you see the flow of monies and what these companies are growing to in size, it's something we don't know how that's going to play out, but we got to be aware of it, and we got to be aware of how much control and power these companies are having. So, it's been good. It's great for the retail investor. It's great for us. It allows us to be more efficient. It allows us to own more things and own them more directly, have more clients to be able to own more things. But I think there's a lot of risks as well that we just have to be aware of and keep up with.
Absolutely. I agree. Great insight, Andy. Thank you.
Thank you.
All right, we just heard about the importance of diversification from Andy, and now we're going to transition to John. He's going to talk about the importance of fixed income in our portfolio. So, John, recently you and I had a conversation, and you mentioned that you've had quite a few clients recently ask you about bonds, and particularly why we own them in this low interest rate environment, and kind of our thoughts around owning bonds. Can you help the audience understand?
I mean, it's become a more common question now that the markets have had at least so far this year, had a great year. And I think throughout my career, I've noticed these windows where market returns are quite strong, stock market returns specifically, and then people start to look at those other assets in their statement and start to question, why do we own something that only made 4, 5, 6%? We have this other stuff that's making 20% or more. There's a number of reasons. I mean, the technical reason that we own bonds is primarily because, as most people know, it's a diversifier. What most people don't know is what that actually means from a technical standpoint. So I've actually brought a chart we can look at here. I know you mentioned the efficient frontier earlier.
Right.
And I think this is a good example of just some examples, and these are just sample portfolios. And this information actually only goes through 2017, but it goes back about 4 years prior. Just sort of looking at different weightings of stock portfolios versus bond portfolios. And as you mentioned earlier, we obviously want to land on that frontier. And what we found with a lot of clients, if you can notice that bend in the chart on the left side, there is an efficient number there. There's a point there where we'd like to land as close as possible. The challenge is that's kind of a moving target because the market can change kind of. So it's a little bit of sort of trying to land in a space knowing that you're probably never going to be exactly on it on every given day. Right. If you look at the next slide, actually, it points to sort of some of the technical implications of adding fixed income. Mm-hmm. If you look at really the two bottom portfolios listed here, one is 60% equities, large U.S. stocks. The other one's 85%. Mm-hmm. I think the interesting thing here to recognize, not to get in the weeds of this, but we look at the standard deviation, which in our industry is volatility. We're trying to figure out how risky these portfolios are. What you see when we go from 60 to 85%, and this is looking at, again, going through the beginning of 2017 and the 10 years prior, what we see is actually about a 12% increase in return. Mm-hmm. But we see a almost 40% increase in volatility for that next level of risk on a portfolio. And I think when we consider our clients, and that would be the next point that I just want to mention, when we think about our clients and what they're trying to accomplish, many of our clients who have higher percentages of fixed income in that 20 to 40% range, typically they are approaching retirement. Mm-hmm. They have some liquidity need in the short term or intermediate term, and they are at some point going to be taking money from their portfolio. And so the second primary point here is that fixed income provides a really nice bucket of liquidity. If we were to go through, let's just say, a very treacherous market like we did from 2007 to 2009, it was quite penalizing for investors who were taking income off of a portfolio while stocks were coming down. So in our mind, and it's a question I've had very commonly, is how do we react if we go into another severe bear market? Our idea is that this fixed income should be non-correlating, as we mentioned in the previous slide, that we see that it'll actually help sort of buffer the volatility in the portfolio, but just as a pure liquidity source as well. If I have a client that has $1 million portfolio and $300,000 in fixed income, if the equities are down, that $300,000 could be a really nice cushion we could draw off of while we let our equities recover. Sure. And I think that's something that a lot of people don't consider when they look at the fixed income portion of the portfolio.
Absolutely. Great advice. So what are your thoughts on kind of the bond market in general and kind of going forward? I mean, we're in a historically low rate environment. There's a lot of negative press about bonds out there talking about if rates do, increase with any significance, the bond prices are going to drop significantly. What are your thoughts on that?
It's a concern. I mean, we are sort of in uncharted territory. We've had rates basically coming down, if you look at the super cycle, for basically 4 years. And we're down, and there's a lot of forecasts that rates will at some point normalize or increase. I think there would be some great benefits from that happening. If it happened really quickly, I think that could be challenging to the fixed income market. So as you know, I mean, one of the things that we try to avoid are longer term treasuries. I mean, to me, as secure as they are from a principal standpoint, long term treasuries are going to be the most hit, I should say, asset class when it comes to, particularly if we see interest rates move up in a quick fashion. And I think what we also need to consider is why we own fixed income. If we get back to what we're trying to do, which is dampen the volatility within the portfolio, we want to make sure that we own the type of fixed income that actually does that doesn't actually ride the waves of the stock market. High yield, for instance, high yield is very attractive. We see a lot of, the data shows that a lot of money has come into high yield mutual funds over the last 10 years, primarily because interest rates have come down. The downside to that, though, is that high yield in a stock market sell-off oftentimes sells off as much, if not more. I mean, these are companies issuing credit that are on the riskier end of the economy. There's obvious reasons why those would potentially sell off. So we want to make sure that the underlying companies that are issuing the fixed income, the quality of those companies are going to be those assets, or are going to basically be issuing those bonds and will become assets that will react ideally inversely to equities, so that if we do have some sort of a pullback, not only will they stay secure, ideally they go up in value. We're in an environment now where that is hard to determine, because how much lower can rates go? And I think that is, most people think about their equities and their stock market exposure primarily and solely, quite frankly. I think fixed income management right now is much more challenging and a bigger sort of hidden threat to investors if they're not properly allocated.
Yeah, I agree 100%. We talked at length about the importance of knowing, what you own in your portfolio. Mm-hmm. And I think exactly what you said. People forget about the fixed income side, right? And they just, buy bonds, just buy whatever bonds to earn income. But it's so much more than that.
It is,
right?
It is. Some people just go after the highest yield. They see a mutual fund or an ETF or a bond, and they say, oh, it's paying 6%. It's got to be better than the one that pays 4%. But what are you getting there? You may be buying something very long term, which has higher duration risk, meaning it's going to be more volatile. It's going to go down more if interest rates go up, simply put. And a lot of people just don't understand sort of the technical aspects of the fixed income market. And I just know in conversations with clients and prospects, so many people who are previously higher concentrated fixed income investors have drifted towards less fixed income. Not to say that that's necessarily a bad thing, but what I worry about are people that are not monitoring their portfolio. They may be drifting into an area of risk that is not appropriate for them, and they probably don't necessarily understand that they've moved into that yet. And I think that's sort of the environment we're in right now. But it's been like that for several years. It could continue, but it could also change very quickly. Sure. I think that's, looking at the next 5 to 10 years, I think interest rates will be a very primary story in the economy.
Great. Yeah. Some great advice. Thank you, John.
Yeah.
All right. Well, we just heard some great advice from John on why fixed income is so important in our portfolios. And now we're going to transition to Cameron. He's going to touch on another very important topic, which is concentrated positions. So, Cameron, can you give us a little idea what we mean by concentrated positions?
Yeah, if we go back to the financial planning textbook, they'll say 10% of your portfolio is in one asset. So that can be land, company ownership, but what we're more traditionally worrying about is one stock, one asset position that makes up a substantial portion of your portfolio.
Right. Mm-hmm. Right. So, how do these positions come about?
Slowly, and then all of a sudden, as they say. So sometimes people inherit stocks from parents. Mm-hmm. Sometimes they have worked for a company and invested in it over a period of time. And the third one, I just call them stock fans, someone who's invested in a particular successful stock like an Apple or Amazon and continue to because it's done well. And in any of these situations, you put your head down and then look up years later, and all of a sudden it's a concerning amount of your portfolio.
Right.
And you'll see basis concerns where what they paid for it versus what it's worth is a big difference, and you got an embedded capital gain tax in those positions.
Yeah. So when you talk about fan stocks,
Yeah.
I like that term. Yeah, we see that quite a bit. That's where we talk about recency bias, right?
Mhm.
So the stock's done so well for you that you see no way for it to ever falter.
Right.
And then
It's hard to blame those people,
Sure.
who have seen a big bump in their net worth because of a good stock pick. So,
Exactly.
but we just gotta,
Yeah.
be unemotional with it.
Yeah. So we've talked in the past about how human beings are hardwired to avoid losses.
Yeah. Yeah.
So can you kind of talk?
Yeah, I
about
wrote
how
an
that
article
fits in?
about that a while back, and I had read some evolutionary biology that I found interesting. Basically, believing that in our DNA we're hardwired to be risk and loss averse. So if you think about man a long time ago, and they see the bushes rustling, is that a tiger about to jump out and get me, or is it just the wind? Well, it'd probably do best if I just ran, regardless.
Right.
So that's something. But then if we look at my first chart here, I call this the kind of arithmetic law of loss aversion. So if you lose something, some percentage of your initial amount, it's going to take something to gain it back.
Sure.
And as the losses get bigger, the gains that you need to recoup your initial investment, they grow at a more rapid pace.
Right.
So if I lose 1% today, I need just over 1% to get it back tomorrow.
Right.
But if my portfolio takes a 50% haircut, I have to double it, get 100% to get back to where I was.
Exactly.
So that's just kind of built-in, tendency towards diversification because of this risk that just comes from the nature of things growing and declining.
Right. Right. So I think you had an interesting example you wanted to share.
Yeah.
with us.
So here's two business owners, and let me quiz you, Brian. You remember this guy on the left here?
I don't.
That's the pet.com puppet.
I remember pets.com very well.
The guy on the right here is famous, Bill Gates with Microsoft. One on the left, more infamous, is kind of the poster child for the .com era. So I hope that whoever was leading that company didn't invest in pet.com stock like Bill Gates did with Microsoft. But the bias for any
Let's hope they at least didn't have a lockup period.
right. Yeah. So any owner should have a bias, towards investing in their company, and that's how wealth is created. We have to acknowledge that. Investing in something that does well will make you more wealthy than if you were diversified. But the problem when we look at Bill Gates and the success he's had being one of the richest men in the world, investing in Microsoft, is for every one of him, there's dozens and dozens of pet.coms.
Sure.
Yeah.
Absolutely.
So that just shows the risk of being married to a concentration.
Okay. Right.
Mhm.
So you've gone through all of these different thought processes, and eventually we determined that maybe this concentration is actually a little bit more harmful than it is good for the client. So can you kind of give us an idea of how you may divest from this concentration?
Yeah, and this is one of those things where it's hard to just say let's sell, because there's a built-in bias against selling, which is the tax we're going to have to pay to get out of it, and whatever emotional attachment there is to the stock. So I really like things that play on the emotional side from the opposite perspective. So my chart here, I'm calling these signpost sales, and this has been a really good strategy for us. So we've had success investing in a stock. It's gone up over time. And we say, today, let's look into the future. A, B, and C points as the stock continues to perform better and appreciate in value. Let's just set some signposts in the road. So we could do this with limit orders in this example and say, as this stock continues to rise, let's just sweep some gains off the table.
Yeah.
We can take our gains, maybe in separate years, hopefully, to smooth that out. But what it keeps us from doing is looking every day and saying, is this the time we're going to sell? No, we want to make that decision ahead of time, knowing that we'd be happy once we got there.
Absolutely.
We've done this with options as well, and that'll let you generate some premium, some interest for the portfolio.
Sure.
So that's all good there.
Yeah, I really like the signpost strategy. I think it's very easy to get frozen in your decision making, like you said. oh, it's such a big gain. I don't know, when can I get out of this? How can I get out of this? I don't want to get crushed with taxes. I think your signpost strategy.
Yeah, so not super detailed, but
Right.
the essence is in the simplicity.
Gotta get started.
Right.
Mm-hmm. Right. So I know you've also written a few commentaries about, possibly using concentrated positions for charitable causes.
Definitely.
Talk
Yeah.
about that a little
Yeah, I
bit?
mean, when I think about concentrated positions, what goes hand in hand is a big tax liability, low basis. And when you think about low basis stock, to me as a planner, that screams charitable giving. If someone has that charitable intent, which is important because you could just sell, pay tax, and keep the money for yourself.
Right.
So we acknowledge that's the best way to get money today. But if you do have a charitable intent, there's some really interesting strategies we try to create a win-win. Right. So I have this chart on a charitable remainder trust. So this is something and there's a little chart depending on how much we wanted income on the left, but the idea is give away that low basis stock into a trust that pays you an income over your lifetime.
Right.
So we can sell it without the tax consequences, receive income over our lifetime, get a tax deduction, a big tax deduction on the front end. So you'll see here for some, kind of classic retirement age people, if they wanted, say, 7% income for the rest of their life, they got a 22% tax deduction. You can see that's a big number. So that's another planning opportunity.
Right.
Maybe I'm thinking Roth conversion, a lot of things we could do here.
Right.
But at the end of the day, if someone has that charitable intent, charities can avoid paying cap gains. So we can get creative.
And at the end of the day, they benefit the charity.
Yeah, so win-win-win.
Yeah.
Exactly.
Mm-hmm. Great. Great ideas. Thank you, Cameron. All right, we just heard some great insight from Cameron on the importance of managing concentrated positions in your portfolio. Now we're going to transition to Frank, who's going to talk to us a little bit about taking taxes along the way. So Frank, can you tell us what you mean by that?
Yeah, Brian, what I mean by that is in your taxable accounts, selling appreciated positions at a gain and paying the capital gains tax this year.
Okay. So tell us a little bit more about why an investor would want to take taxes in a given year versus letting us continue to build.
Well, again, piggybacking off of what Cameron was just talking about, you want to avoid the concentrated positions, and really you want to avoid getting stuck in the high gain positions and taking away your options in future years. And so, gains can be great, but they can be a hindrance if you're so tax averse that you get hamstrung in those positions, and then you're not able to make the moves that you would otherwise be making in a portfolio. So getting rid of the concentrated positions, getting out of the high tax positions, so taking your taxes this year will allow you to be more agile in the years going forward in the way that you want to maneuver your positions in your portfolio.
Okay. So what you're basically saying that we don't want to get hamstrung because of taxes, because it will allow us to invest in the assets that we actually feel like have the best opportunity to grow. Is that what you're saying?
Absolutely. And some of these concentrated positions and high gain positions have been great. I mean, there's a reason they have a high gain is because they've appreciated so much. But you really introduce an element of a single stock risk when you allow that to get those positions to get as high as they are in a portfolio, and especially then when you're not willing to get out of them for tax reasons. So that's what we're talking about.
Okay. So when you mention taxable accounts, do you have certain strategies that folks can follow to try to take those gains along the way efficiently?
Sure. And I think backing up a little bit, that's the most important part, is to have the strategy. Have a strategy, have a plan thought out in advance, and then stick to it. Be disciplined in following whatever strategy or plan that you pick, and that'll help you avoid making emotional decisions in the future. So a great strategy is a signpost sale, as Cam was talking about. Pick an amount that you're going to sell at a certain level and in advance, and then when that time comes, it's you're ready to make that sale and you've thought about it in advance. You can also have a strategy to say you're going to get rid of X percentage of a certain position in a given year. Well, make it flexible too, so that if you have a year with lower income and a lot more deductions, sell more.
Mm-hmm.
And then the opposite in the years that you have a higher income and less deductions, sell a little bit less. But think about it in advance so that you're ready to make the sale when the time comes in a given year. If you're charitably inclined, doing the charitable trust that Kim was talking about, a great strategy there. And then tax harvesting at the end of the year. If you've got positions that have a lot of built-in loss in them, sell those and offset them to the high gain positions. And that can really help mitigate the tax bill that's going to come due in April, but also work you out of those high gain positions at the same time.
Yeah, so that's a great point. I think also when we talk about, simple things like rebalancing your portfolio, explain how important it is to
Absolutely.
be able to have the freedom to do that.
Absolutely. And in rebalancing, you're selling out of what's high and you're buying into what's low, into the portfolio positions that you want. And that's what, the basic investing strategy is, sell high and buy low. So by following that strategy as well and being willing to take the taxes as necessary to do that. And I think that's kind of the main idea, is you need to get over that mental hurdle of avoiding taxes at all costs and realizing that, that may be great short term this year, but down the road that could really hinder your performance in what you're trying to accomplish long term.
Yeah, so when we think about, our tax deferred accounts, our traditional IRAs, our 401ks, we're not talking about obviously taking capital gains taxes or paying capital gains taxes along the way, but there are some other strategies about taking taxes there. Can you mention some of those?
Right, absolutely. So the strategy would be to converting a traditional account to a Roth account. And so when you do that, you're going to pay the tax in the year of the conversion, and then your gains and income in the Roth account when you withdraw going forward, if you follow the rules set forth by the IRS, that's all going to come back out tax free. In Kentucky, we have a great opportunity to an exemption from retirement account withdrawals of $31,110 per taxpayer. So what that means is that you can convert $31,110 under current law from traditional to a Roth and avoid state tax on that. And so here we've got a chart that's just showing your ordinary income tax and your capital gains tax rates over a period of time up to 2018. And the whole point of this is to show there's no rhyme or reason to it. All things considered relative, we're in a relatively low tax rate environment now. Mm-hmm. And so why would somebody take the taxes this year? Well, you don't know what's going to happen in the future. We can't sit here and predict what the tax rates are going to be. And I don't think anybody can. But if we're in a relatively low environment, the thought would be taxes may go up at some point in the future. So if that's the thought, by paying the taxes this year, when you have certainty of what your situation is and what the tax situation is, you can eliminate that unknown variable in the future. And so you'd be paying the premium, your taxes this year to do that, but you would then have more certainty down the road.
Right. Some great ideas there. Thank you, Frank.
Thanks, Brian.
All right. I want to thank everyone for watching today. It's been a great opportunity to share our thoughts. I mean, we believe in transparency in this office and sort of sharing how we think on a day in and day out basis about not only the planning process, as we've discussed, we've focused so much on in the past, and we write so much about. I just think this was a great opportunity to share, some of the investment management thoughts we have. And as you mentioned, we're going to be going in much deeper on these topics over the coming year. I think it's a great opportunity really on each one of these sort of mini presentations we got from each advocate. You could go on for hours potentially on each one if you really wanted to. Right. And so I think this is a great summary to the end of the year. I think the idea behind today's presentation is just for people to think about maybe their investments in a slightly different way. Sure. That's a good thing if that came out of today's presentation. And maybe also maybe think about the risk that they're taking in a slightly different way. Maybe it's a concentrated position, and now they're thinking maybe about a charitable trust or some possible strategy that could benefit them. So again, I want to thank everyone, and do you have any comments?
Absolutely. And just to reiterate that, we want to thank you all for, if you've made it this far, for watching the video, but also thank you for your support and your trust. It's something we don't take lightly. So as we mentioned at the beginning, our Athenium book, we will have our third version finishing up at the end of this year. And next year we'll release that, and we'll have a full compilation of 12 topics, probably about 250 pages of our thoughts and really a thorough understanding of the way we think about financial planning and different ideas. So we look forward to sharing that with you. as we said at the beginning, if there are any questions you have as a follow-up with this, please let us know. You'll have access to this video, and again, share it with anyone who you think could benefit from it. So thank you all again for another great year, and we look forward to talking to you soon.